Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to CEO Sandy Chadha and CFO Suzanne Smith of Supreme, a leading owner, licensor, distributor of FMCG brands across vaping, sports, nutrition, lighting, and batteries. So welcome, guys.
Thank you. Nice to be back. Thank you.
Well, fantastic set of first half record results. Actually knocking the ball out of the park with sales up over 60% to about 105 million. So maybe we can start there, Sandy. What's been driving that sort of terrific top line growth?
So it's a combination of a few things. All our product categories are growing. Our vaping categories have done exceptionally well. Our wellness category is growing. And I think also with the cost of living, I should say more the sort of cost of the raw materials are starting to come down a little bit, which is also now helping the margins too.
Great. And then just on that sort of top line with the vaping, I did see that's obviously sort of taken off in terms of the really success you've had with the Elf brand, along with your own existing brands, which I think has done very well. Can you just talk through that?
Yeah, so our existing brand is 88 Vape, which is still current and growing on late single digits to early double digits growth, along with the Elf Bar and Lost Mary opportunity into retailers, supermarkets such as Tesco's and Morrison's are performing really well. And so overall, when we first took on the distribution, we're very new to this area. We weren't sure how well it was going to go, but it's actually exceeded what we thought it was going to do originally.
Great. And then just again, Sandy, just on the other divisions, you've seen pretty good growth in sort of, your lighting, your sports and nutrition as well. Is that increased distribution or is better promotion or new products?
Yeah, a combination. Batteries now are in W.H. Smith Travel. We've managed to grow our batteries top line as well as our margin. The wellness is now going to strength to strength. The Cymex brand particularly is really strong. We're seeing strong growth in private label in that area, and also the vitamins that we started to. We're going to have another push on those. In terms of actually the vaping category seems to be like the main hero, but overall all our categories are performing better or as good as we expected them to be.
Fantastic. Okay, so putting all that together, Suzanne, you've actually exceeded with EBITDA more than the sales uplifts, because that's up, the EBITDA's up 87% or so. So really, we got operating them. Can you just talk through how that sort of worked through into profitability and then obviously working capital and I think you've got a slight net debt position.
Yeah, so it's a clean sweep really across the board in terms of financial metrics. I think my job has probably never been easier in terms of delivering a set of results. As you've already touched on, revenue and EBITDA are up, particularly EBITDA 87%, as you say, up to 15.2 million. And it's really important to note that even the other metrics aside from that, so gross margin as a percentage of revenue is up. Our overheads, yes, they're up year on year, but not to the same degree as we've seen as in revenue growth or even gross margin expansion. The overhead base has remained really tightly controlled. It's also really important to note that, as Sandy indicated, Supreme is not a one-trick pony. It has 5 clear independent divisions, and we've seen growth in all of those divisions without exception, both in top-line revenue and in gross margin as a percentage of sales. Whether that's been better buying or more consolidation of our purchasing synergies, whether that's been an increased propensity for manufacturing, consolidation of manufacturing. You'll also know we've consolidated some of our distribution as well. It's been a number of elements. We've seen recovery in our raw material input prices in sports nutrition and wellness, which has helped to drive better margins. It really has been contribution from all elements of the business, grocery, discount retailers, convenience retail, so all of the different types of customers we deal with across all of our product categories, across all our various kind of business models as well. So absolutely delighted to see these financial results. And we've also spent time in the first half of this year integrating some of the businesses we acquired in FY23. So FY23 was definitely kind of accentuated by the M&A that we did in the year. Well, that's how FY23 will be remembered. In FY24, we've spent a lot of time and effort consolidating those acquisitions, bringing their manufacturing in particular into our principal site in Manchester, which has driven economies of scale and less touch points and more efficiencies. It's also driven down our gross overhead base. So yeah, there's been a real consolidation in the business this year. We can't not talk about the ELF opportunity. That, of course, has been a leading factor in the performance year on year. It's generated that contract alone has generated, or that opportunity, I should say, has generated upwards of around £26 million of incremental revenue, and has definitely contributed to our adjusted EBITDA performance. But it really has been performances right across the business.
Well, you're certainly very modest there, Suzanne. You started that with, it's been very easy as a CFO, but given what you've just said, then you've had a lot of balls to juggle. Just in terms of sort of the cash position, I just noticed the net debt has just, well, it's just moved from a slight cash at the year end to a slight net debt position. Is that working capital build ahead of sort of Christmas?
It is. You're absolutely right. Not just because of Christmas. So we've invested £16 million into the working capital profile to support the ELF opportunity. So that's across debtors, it's across stock, and also the deposit payments that we're paying to the manufacturers in China. It sounds like a lot, but then the size of the ELF opportunity is equally and proportionately interesting and kind of scaled. We have managed it as tightly as possible. We're turning stock within a matter of weeks, and even our debtor balance, whilst as a wholesale absolute number is kind of 30 to 40 days, for some customers even less. So whilst it's an investment, it's a very managed and tightly monitored investment, and a necessary investment to drive the kind of top line growth and the profitability. Had it not been for the investment in ELF, we would have been reporting a £17 million operating cash generation for the 6 months, which is phenomenal. That's basically saying that EBITDA is dropping straight into cash, which across the rest of the business is absolutely true. We've had a quieter period for M&A in the 6 months, but we have been servicing the deferred consideration obligations from the M&A we did last year. And of course, we've spent money fitting out the ARC, which is our principal warehousing facility. So we've, aside from the ELF investment, we would have certainly been generating cash in these 6 months, and we fully expect to in the second 6 months. Now that investment into ELF is behind us, so the business remains extremely cash generative and is financing working capital really to drive growth.
Well, that's great, because you'll certainly get the optionality sort of towards the year end about what you want to do with that extra sort of cash. Now, Sandy, I listened to an interview on BBC Radio 5 Live yesterday, and you suddenly appeared talking about sort of the vaping industry sort of measures. Can you just talk through how the company is becoming sort of like thought of as the best in class sort of operator in this, and what measures you've done, and how you've seen that sort of like introduced across the industry, or introduced in Supreme?
Yeah, no, as you all know, there's a consultancy that's going on with the government that's going to be concluded on December the 6th. Probably by end of January, we'll have an idea of what that looks like. We know a few things that potentially could happen, and we've looked at it and said, you know what, we're happy to start moving in the right direction to be a responsible manufacturer. So we don't want our products to appeal to children. For that reason, we've moved away from any of the coloured packaging, and we're going toward plain packaging and simplified flavours. We're also recommending our customers have a over 25 age policy, and that they keep the products away from any confectionery, toys or sweets. And also, we just want this industry to be a little bit more cleaner. I mean, we're getting a lot of bad reputation from a very few companies, but generally the more traditional vaping companies like ourselves are pretty responsible.
And just in terms of sort of like the measures you've introduced, you've got sort of plain packaging, and you've sort of like with the flavors, you've moved to just sort of straight flavoring and this sort of stuff, and then also with the recycling side of it. How is that impacted at all the sort of sales of Supreme's products? I'm guessing from the knockout results, since you've introduced, it hasn't really made any noticeable difference.
Okay, so the actual introduction is happening now, in terms of it will take a period of time for it to flow through. But we believe that will not have a single impact on our sales, because we believe that most of our products are sold and bought by adult vapers, and is it going to make a difference to them if the packaging is not as shiny or bright? No, they want the nicotine to stop them from smoking. That's why they're vaping 88 vape.
Yeah.
So I guess we believe that there won't be an impact on our sales at all on this, and we decided that it's the right thing to do for the company and for the industry.
Brilliant. And then I understand when we last chatted about a couple of months ago, you just about to introduce a new sort of like recyclable or reusable vaping device. How's that going?
Yeah, so we've got a pod device that's coming out and we are ready to launch. We are waiting for guidelines really mid-January before we launch. Launching a product just before there's going to be changes into possible legislation. We just want to be sure that we are on the right side. So we're ready to go, but we think like we'll be ready before end of January before we launch that.
Okay, great. Now, Suzanne, just in terms of sort of the overall outlook for the rest of the year, obviously we've got a bit of Christmas, and we've got obviously normalization of the Elf brand, etc. How do you see the rest of the year sort of shaping up? Obviously, you've just upgraded the guidance.
Yeah, so we've been up to this point, we've been very cautious around Elf, mainly because it has been such a new opportunity for us. We were rolling out with customers. We were really getting to grips with what the kind of landed costs and the overall margin would be. It feels like now we've got enough trading under our belt and we've got a good line of sight to year end that we can be more confident with the forecast that we're happy to stand behind, and that's probably been the first time we've been able to do that. Now we've been in this game for 6 months with Elf now, and we are starting to see kind of the initial pipe fill orders are calming down, and we see like a really nice cyclical order pattern with some of the big retailers. So we feel much more confident now in committing to a more realistic forecast for Elf. Elsewhere in the rest of the business, as Sandy's already alluded to, the business has certainly outperformed last year and has across the board outperformed our expectations of how this year would go, both in terms of top line revenue and more in particular how efficient we've been in our margins. We don't see any reason why that's going to slow down in the second half. We're now 2/3 of the way through what we call our golden quarter, so October, November, December. So obviously we have visibility on October and November, and that's what's really driven the upgrade today on the kind of core business. You'll see that the upgraders had inferences to the Elf opportunity, but also the core business is outperforming our previous forecast as well. So yeah, we have a really good line of sight to the year end, feeling really confident that nothing seems to be slowing the business down, and every category continues to drive incremental margins than it had done the year before. So yeah, feeling really confident with the numbers that we've put out this morning.
Great. Well, I would highlight to investors, I mean, I've run those numbers through my model, and I get that the current share price that the business is trading on 6 times PE ratio, which looks ridiculously cheap. And I have a fair value now upgraded from £2 to £2.25. So I think there's significant upside. And I also would add to investors such that once the consultation, the clarification of that is removed from the industry, I can see a significant uprating of the whole sector, and certainly of Supreme, because it looks stupidly cheap. But that's just me as a personal sort of like investor with sort of 30 years experience. Anyway, just Suzanne, just in terms of sort of like current news flow, or it's not news flow, what would you expect? Are we going to have a trading update perhaps in January?
No, unless we have an absolute belt in December. I think we have baked our year-end outlook now into the forecast that we've provided this morning. I think this is the first time, like I said, we've really been able to be confident with the numbers that we are standing behind for Elf. That's not to say if the rest of the business continues to outperform even our expectations now that we won't be back here again. But I think that this is a number we feel really, really good about. I think in the previous 2 upgrades, I think if you'd have read our body language, it was, yeah, this is as much as we want to commit to now, but let's see where the rest of the year goes. Now feels like a really solid footing and a real certain forecast.
Brilliant. Well, that's a great place to end the conversation. Really well done, and yeah, I love the upgraded numbers. So well, thanks very much for your time, guys, and look forward to hearing you on the telly next time, Sandy, as well.
Thank you. Thanks,
Thank you.
Bye.